Welcome to Mineral Projects Intel, where we dig deeper into the world of mineral projects, where we unpack the complex world of mineral projects investment, and where we make sense of the science, strategy, and sometimes the jargon behind it all. If you have been wondering about some risks in mining investment and the future of mineral investments, you're in the right place. Imagine owning shares in a mining company that announces good drill results, promising geology, and huge upside potential. The share price spikes briefly and then quietly collapses. Months later, the company raises capital again. And again. And again. Your percentage ownership keeps shrinking, but management keeps assuring you this is non-dilutive growth. What you may actually be watching is something far more dangerous: the ATM financing death spiral. ATM financing, or at-the-market financing, has become one of the most misunderstood and most abused funding mechanisms in junior mining.
Today, we're going to unpack how it works, why mining companies love it, why investors should be cautious, and how constant capital raising can quietly dilute shareholders all the way to zero.
But first of all, let's be clear. ATM financing does not only apply to mining. It's a general capital markets tool used across many sectors. What is unique is how ATM financing becomes most dangerous for existing shareholders in mining. In sectors like technology or consumer goods, companies often have revenue, margins, and growth loops. Capital raised via ATM may fund expansion that quickly increases cash flow, which can support or even lift the share price. Dilution can be offset by earnings growth. Mining is different. Most junior miners have no revenue, long development timelines, and value that only crystallizes very late, often years after repeated capital raises. ATM financing in mining therefore tends to transfer upside from early shareholders to later ones, rather than create new value. Shares are sold continuously, sometimes daily, whenever the company wants cash. In short, and this is critical to understand, is that the company raises money by quietly selling new shares into the market over time, gradually diluting existing shareholders. For shareholders, it is a slow-motion value destruction machine. So why do companies even use this ATM financing tool? Well, unfortunately, the fact of the matter is that mining companies, particularly juniors, are capital-intensive and cash-hungry. Drilling, assays, consultants, environmental studies, mining right renewals, and corporate overheads never stop. Many juniors have no revenue, only expenses. ATM financing gives management much-needed flexibility. There's no need to time the market perfectly. Whenever the share price ticks up on drill results, commodity hype, or market optimism, the company can quietly sell more shares into that strength. From management's perspective, it feels painless. But this is where the problem starts. Let's discuss and explain why ATM financing can be a death spiral for early investors in mining projects. The company uses ATM financing to raise money for drilling. When drill results are released, the share price rises briefly. Management then sells new shares into that rise to raise cash. That selling pressure caps the share price, and the price can drift lower. Now the company needs more money, because drilling never ends. But the share price is lower, so more shares must be issued to raise the same amount of capital. This increases dilution further. Existing shareholders now own a smaller percentage of the project they originally invested in. In mining, this is particularly dangerous because value is only realized very late, at feasibility, financing, or sale. If your ownership keeps shrinking before value crystallizes, the shareholders are at great risk of actually losing money, even when the mining project is a success. Let us delve deeper into why ATM financing is worse for investors in mining than other sectors. Mining is different from tech or consumer businesses. In the early project phases, there is no early cash flow, no recurring revenue, and no margin expansion story. A mining project's value is locked in the rock and only becomes real after years of capital expenditure when it eventually goes into full-scale production. If share dilution occurs continuously before the asset is de-risked, the upside that was supposed to reward early investors gets transferred to new shareholders and management stock options. In extreme cases, early investors end up owning a fraction of a percent of a project they once meaningfully backed, even if the deposit turns out to be real. Here are some of the red flags investors should watch for. One major red flag is permanent capital raising language. phrases like ongoing funding flexibility or capital raised as needed. Another is when a company never seems fully funded for the next milestone. If a company says it needs money for drilling but doesn't explain how it will fund the next stage, dilution is coming. Also, watch management behavior. If salaries, overheads, and corporate costs are stable or growing while shareholders are diluted, the ATM is serving management, not investors. In mining, the most dangerous phrase is, "We'll just raise more capital later." ATM financing is not always evil. It can make sense when a company is near production, has strong institutional support, or is bridging to a clearly defined value event like a feasibility study, project sale, or construction financing. The key difference is endpoint discipline. If there is no clear end to dilution, ATM financing becomes a slow bleed rather than a bridge. Investors are not automatically protected from dilution, especially in junior mining, but they can protect themselves by knowing where, when, and how dilution happens. Protection comes from structure, timing, and behavior, not the mineral resource alone. Here are the practical ways investors protect themselves. First, funding visibility matters. A company should be funded to a clear value milestone. For example, fully funded to feasibility, or funded through the next drilling phase with no further equity required. If management cannot clearly state this, dilution risk is high. Second, watch the share count trend. If shares outstanding keep rising every quarter, even when news is positive, that's a warning sign. A good project with bad dilution can still destroy value. Third, rights issues protect existing investors better than ATM financing. Rights issues allow current shareholders to buy new shares in proportion to what they already own, preventing ownership from being diluted if they choose to participate. Fourth, strong cornerstone or strategic investors help. Institutions or industry partners often impose discipline on management and limit endless capital raising. Our presence reduces the temptation to sell shares casually into the market. Fifth, look for management alignment. If executives own meaningful equity bought with their own money, not just options, they feel dilution personally. Management teams that rely mainly on salaries and options have less incentive to protect shareholders. Sixth, check whether the company uses debt, royalties, streaming, or joint ventures appropriately. These can reduce equity dilution if used carefully, especially at later stages of a project. To end and summarize this video, I will reiterate that ATM financing doesn't usually destroy value overnight. It erodes it quietly, one raise at a time, one dilution event at a time. In junior mining, where patience and capital discipline matter most, constant capital raising can turn even good mineral resource base into a terrible investment. To be clear, people invest in junior mining despite the risk because the potential rewards are huge. A small early stake in a successful project can grow many times if a deposit is proven, financed, and brought toward production, even though dilution is a real threat. As investors, the question isn't just, is the deposit real? It's also, will I still own enough of it when it matters? If you found this interesting, like, subscribe, and share for more mining insights. Because in the world of mineral projects, knowledge isn't just power, it's value. Thanks for watching.